What is going on, everybody? Welcome back to another episode of That Makes Zero Sense, the podcast. My name is Alex Ivanovich. I am a trader and investor at Spoonbill Partners LLC. We trade stocks, bonds, derivative products, private and public markets, you name it, and we've probably traded it. Now, on today's episode, we're going to keep it a little bit shorter. I've got two things to discuss as it relates to markets and macroeconomics a little bit. And then at the end, I wanted to discuss a little bit of a trader's tip. I didn't make a whole lot of trading tip short form content this week. And so I thought it'd be fun to throw something in for the podcast, especially since I think this one is a pretty good one and not something that's talked about too often. Something that I was forced to confront this week, and it's going to come up time and time again in your life as a trader. And I think it's a good one to keep in the back of your mind. So without further ado, let's jump right on into the episode. We've got an exciting one today. We are going to start off with, where else are we going to start off other than talking about tech and semis in general? So let's start there. I think on the last episode, we discussed Samsung obviously having this great quarter, and then on the quarter, the stock sold off, and we talked about how expectations were sort of priced in already. Now, today, on the time of this recording, Wednesday, we just had ASML report the night prior. So, today was the first full day of trading with that report in for market participants to digest. And very similar thing happened. I wouldn't say it was as exaggerated as Samsung. ASML reported a phenomenal quarter. I don't think there's any question about it. There was a couple of things that I read in this Wells Fargo note that were maybe construed as, maybe some hair on the report, but nothing super major in terms of negatives. Just to give you guys a couple of numbers, quarter two sales, $9.3 billion versus the $8.8 billion estimate. Gross margins were 54% versus the 52% estimate. They raised the fiscal year guide to $43 to $45 billion from $36 to $40 billion range. That's a huge bump. 2027 order book is full and they're taking 2028 orders. ASML, if you've been paying attention to the price action over the last few months, is a very stretched stock. I want to give a quick shout out. I mean, he doesn't know who I am, so I know the shout out's not going to mean anything, but at the beginning of the year in December, one of these guys from Mizuho, Jordan Klein, had a phenomenal call. I want to say ASML was like 800 or 900 bucks or something like that. And within a few months of him making this long call on ASML, the stock was trading at like 1400 or something crazy. He made a great call. Basically went in a straight line from sub 1000 to 1400. If you're looking at the US ADRs of the stock on ASML. But let's come back to today. So obviously a very stretched name. There's a lot of long only funds, a lot of hedge funds involved with ASML. They're holding that stock. It's obviously sits at the very top of the semiconductor supply chain. And for those of you that don't know, ASML produces these EUV machines. I'm not going to even try to break down what EUV means. It's like electro something lithography. I don't know exactly how to say it, but they make these very specialized machines that chip producers purchase to produce chips. So companies like TSM, for example, if NVIDIA designs their own chip, they'll bring the design to TSM, and TSM will use a machine that they bought from ASML to produce the chips. That's sort of where they sit in the stack. ASML provides the bulldozer for all of these companies to go find their gold, make their gold, whatever, however you want to spin it. And so they reported this great quarter, and the stock, when I was watching it trade this morning, is up like 2 or 3%. And I thought, gosh, that's interesting for a stock that blew out the quarter. And, AI is obviously a super popular theme this year. You would think that this sort of reaction garners like a 10 to 15% move. I know it's tough to move ASML that much, but you'd think, it'd be high single digits and low double digits percentages, right? And so for it to be up only 2-3%, it was a little bit of an eyebrow raiser for me. And then surely enough, when the opening came, the stock plummeted and went unchanged on the day and even started to trade negative. I didn't see where it actually closed. It might have closed just slightly negative on the day. But despite all of that, for a quarter to be that good and then to have that sort of price action is very interesting to me. And then to see how the semis in general react today to a great ASML report, I think is super telling of where we are with semis. The good news has been largely baked in. Most of the semiconductor complex, all of these stocks, anything that has anything to do with AI or data centers has seen these huge run-ups, and so expectations are extremely elevated. And even when you get a print like this, it sort of becomes this sell the news idea. Sell the news. We've talked about these sorts of things in the past. I'm not going to go into it again. You saw it in Samsung, and now you saw it today in ASML. Great news, not a lot of reward. Very interesting. And so I also think that the thing that we need to pick apart here is the capacity comments from ASML. Semiconductors in general, we've spoken a lot about how memory is cyclical, but semiconductors in general have been mostly a cyclical business for the better part of history. And with these comments from ASML about adding capacity in order to meet the demand of its buyers, I think might have spooked participants a little bit. You have these crazy run-ups in these stocks. People are sitting on some huge unrealized gains right now. And it's typically at this point in the cycle when capacity starts to get added. You already saw Samsung talk about it. You saw SanDisk talk about it. You saw Micron talk about it. And now you're hearing this company who is sort of the most important company because they're the only company in the world that makes these EUV specialized machines to create chip technology. So arguably they're one of the most important companies in the world as it relates to the semiconductor complex. And they're starting to say that we're going to have to bring capacity online to meet the demand of our customers. We might be approaching the point in the cycle where capacity is going to start to sit idle if it gets added. And there might be a bit of a supply glut, which causes pricing power to erode. We've discussed all of these dynamics on episodes prior. But I think that is what participants are a tad worried about. And it's something I've been talking about on the show for quite a long time. And on that note, I think I need to walk back some of my comments. I'm not going to say that I was wrong because I don't think the idea or the thesis has really had a chance to play out yet. But I've been making a lot of comments about how memory is cyclical and this will happen and there will be a supply glut. I think the data right now is showing the opposite, and I might be a little bit wrong at this moment in time. Management team at ASML says there's clearly a need for more supply in DDR and HBM, which are just two fancy terms for specific types of memory for AI related purposes, but expanding capacity 30% this year and another 30% next year. That's how booms turn into busts. And like I said, ASML sits at the top of the semiconductor supply chain. So if pain does start to occur, that's going to cascade down the supply chain and start to impact some other players in the semiconductor complex. And historically, it's been a pretty good trade to fade semis when capacity starts to get added. I don't know if you remember, but on last week's episode, I put that little graph of when multiples start to contract versus when capacity gets brought online as it relates to memory stock specifically. But that trend seems to be pretty consistent across semiconductors in general. Now, on the topic of semis, I want to discuss a very small data point that came across the screen today that I didn't see really anyone talk about in much detail, but I read it and I pointed out to a couple of my friends. CoreWeave is exploring different ways to hedge against memory prices. Now, once I read that headline, I was like, well, what do they mean? Are they hedging against prices going up, going down? What's going on exactly? So they're exploring using financial products, specifically put options on memory stocks to hedge falling chip prices. Now, the reason for this is because they signed price floor deals with Micron and SanDisk, and they're stuck overpaying if the prices of memory drops. And obviously memory is super expensive right now. So if prices even drop a little bit, you want to be able to take advantage of that. Now, CoreWeave by no means is a super giant large company, but they are one of, I would say, one of the poster childs for this whole AI boom and AI race. Obviously they IPO'd, I think last year, if I'm remembering correctly, relatively recent IPO. Basically what they do is they build data centers and rent out compute. And so this sort of a player buying downside insurance against memory going down is sort of an interesting tell. I don't know that they have information that none of the rest of us have, but if you think that memory is truly the growth story that every analyst claims it to be, and everyone in your industry is like, we can't buy enough memory, we got to double order, we got to get as much as we can because supply is so scarce. It is interesting that one of the larger players is now hedging risk against these price floor deals that they've signed with certain companies. If the thesis for long memory is so strong, I don't think that would really come up for a company of CoreWeave stature. Now, the final thing I want to talk about as it relates to markets, specifically stock markets and AI, data centers, all that jazz. Another little data point that I read about this week: hyperscaler credit spreads are starting to widen. Now, this is very, very interesting because I think Oracle was a great canary in the coal mine for what's happening right now. If you remember correctly, Oracle, I'm going to get the timeline wrong here, but I don't think it was quite a year ago, but some months ago, Oracle credit spreads started to widen very aggressively because of how much money they were spending, the debt they were issuing. They were truly, truly bombing their balance sheet just to build out data centers, to bring compute online, and to be one of these frontier players of AI. And when the credit spread widening happens to a certain degree, the stock got absolutely punished. I don't remember the exact percentage that went down, but that whole scenario playing out, I think, like I said, is a good indicator of what might come. And so, what am I talking about here as it relates to hyperscaler credit spreads? Hyperscalers like Google, like Amazon, Microsoft, Meta, they have historically been cash return machines. They do tons of buybacks, or they were doing tons of buybacks. They were returning cash to shareholders by any means necessary. They were asset light models. And now they've turned into these cash devouring, free cash flow destroying machines. They're issuing debt, they're issuing equity, they're issuing whatever they can to raise money by any means possible to be at the front of the AI race and to build out as many data centers as possible and to bring on as many megawatts, gigawatts of compute capacity online. So these are no longer the sweethearts of the stock market like they once were. And so you're starting to see that show up in the bond market through their spreads. And just to paint you sort of a picture of how expensive these things are getting, Meta has one data center that they're building in Los Angeles that was originally supposed to cost $27 billion, now is going to cost $50 billion. Amazon this week issuing $14 billion in debt, $17.5 billion credit facility. Google obviously did their $80 billion equity raise a few weeks ago. And so this whole build out is requiring the market to keep absorbing this supply of debt and equity. And if the deals stop, if the spreads widen too far, if things get a little too risky, the capex might stop. And so if you start to see these stocks aggressively trade lower because of this, like we saw what happened in Oracle, you might have this event where people are not showing up to purchase the bonds or purchase the equity. Maybe they're not as easily raising money because they're not the sweethearts of the stock market like they once were. And CapEx might have to slow down a little bit, which would obviously spell terrible, terrible things for the rest of the AI complex, the semiconductors, the connectivity technology, the energy infrastructure. That spells bad news for all of those things. And that makes up a large percentage of the market. So that's all I have to say about the tape in general. I think you're seeing some of this softness, one, because of the run up in prices, expectations got just a little too high. And so it really, truly will be interesting for the rest of the reporting season. We're obviously just at the beginning of this reporting season right now, and there's a lot of companies to get through, a lot of companies to report. If expectations are truly this high and companies can't rally on adding capacity, commentary like ASML did, or maybe even one of them guides down or somebody cuts CapEx, or who knows what the commentary might be that's construed as negative, you could see some really, really sloppy price action, as we've seen the last few days and as we've seen in Samsung, Micron, and in ASML. I don't want to make a clear call here, but it could be the start of the end a little bit, maybe. Now let's talk about inflation. Let's move on from stock market specific stuff. Obviously, June CPI came in soft. PPI this morning came in soft as well. They both missed. Bonds rallied. Gold rallied. Obviously, this is great news for our new Fed chair, Kevin Warsh, who just finished some testimony on Capitol Hill. His goal has been to get inflation down to target for a while now. He said that since the beginning. So these are good prints for him for sure. But the one caveat to all of this is that the disinflation was primarily an oil story. Now, the last month or so, there was obviously the MOU signed between the US and Iran. Oil prices came all the way back into their pre-war levels. And so a lot of the disinflation that you saw in these prints, the reason why they came in cooler is because oil prices have significantly come in off the highs. Now, as of this week, there's been some renewed tensions in Iran. The US has been striking Iran. Iran has been striking US assets in the region right back. And oil has received this bid once again. I want to say it was like, I think West Texas Intermediate was like $80 a barrel again, maybe even higher. And so, although seeing these soft CPI and PPI prints, they were celebrated and you saw the stock market tick up when these things happened, although it's great news, I think this stuff going on in the Middle East this week is sort of, in my head, sort of cancels out what's going on with CPI and PPI. I wouldn't be so quick to celebrate that story quite yet. As Kevin Warsh has said many times, he doesn't want to move too quickly and make too many assumptions. He doesn't want to move too slowly and be too passive like Jay Powell was. And I think that's a good, firm stance to have because, as we can see, the situation in the Middle East is very fluid right now. There seems to be a new story every couple of days, and oil prices react to every new story that develops. And right now, the story is that the MOU has basically been crumpled up into a ball, thrown in the trash. We're back to where we were at square one. We might not be boots on ground, but there are strikes definitely happening, and ships are not transiting the Hormuz safely. And so what seemed like a celebratory CPI and PPI, I would just hit the brakes on that, and we need to keep on watching how this situation unfolds because, like I said, the majority of the disinflation was due to oil. It wasn't really due to anything else. And if that becomes a problem and remains a problem, we'll go right back to square one. Consumers are going to feel squeezed. You might start to see retail stocks trade down again. People are going to start to shop at their discount retailers once again. And using the stock market as a barometer for what the CPI and PPI means, I think is quite silly. I think the reactions that we saw this week were mostly faded. I mean, the initial news was buy the tape, buy the market, buy everything that's winning based on these prints because it means that there's a lower probability of the Fed hiking rates if inflation starts to come in on its own. And I'm still in my head a little bit about whether the Fed is more inclined to hike or more inclined to cut. I think they're in sort of a wait and see approach right now. But seeing the probabilities of a Fed hike go down just because of these two prints, I think is a little bit premature on the market's behalf. And I wouldn't be so quick to make that judgment. I'd prefer to sit and wait and watch how this situation unfolds. So that sort of finishes my CPI and my PPI commentary. I'm by no means a macroeconomist, but I do pay attention to these things quite closely and how they relate to the stock market. And so I felt like it was important to talk about on the show today. So let's move on to the fun bit of the show. We're going to go through a bit of a trading tip. Quite interestingly, I've not been reading a trading book recently. I like to always have a book on hand and reading something. And learning something new every day. I think Charlie Munger, I'm going to mess up his exact quote, but Charlie Munger said, you don't have to fear the guy who's got a 200 IQ. The guy you have to fear is the guy who relentlessly learns one new thing every single day. And so when I heard that, I was like, gosh, I need to start reading more. I heard that quote many, many years ago. And so I've made it sort of my young adulthood life mission to always be learning something, try to learn something new every day. And I'll try to always keep a book on hand. So in those dead periods of the day, I'm reading, I'm going through the market, I'm going through my trades, doing something. But anywho, put that aside for a second. I'm reading a book right now about confidence by Dr. Nate Zinsser. I'm forgetting the exact title. I think it's Confidence, the Battle-Tested Guide for something. I can't remember the rest of the title. But in that book, there's a section that discusses how to deal with negativity and losses. I'm going to speak a little bit in trading terms. He doesn't really speak in trading terms in the book. He sort of uses a lot of sport analogies, which is great because, like I've said on this show, sports is a great imaging tool for how we trade. There's a lot of parallels. So he uses a lot of these great analogies for sporting, but a lot of them apply to trading as well. And in one section of the book, he discusses how do you deal with negativity, how do you deal with mistakes, things of that nature, things that chip at your confidence. And one part of the book that really stuck out to me because I used to play basketball, something called the shooter's mentality, where if you're hot, if you're hitting your shots and you just can't miss, you're Steph Curry for the night. That's building your confidence. You're feeling good, but you need to believe that your hot streak is never going to end. That this is you. This is how you do things. And you might start to take a couple more shots. Obviously not riskier shots, but if you're feeling hot, you're telling coach like, "Hey, set up the play for me to get the ball." You're telling your teammates like, "Hey, I'm on fire tonight. Find me in the corner, swing the ball over to me. I'm going to pop that corner three." Like you're feeling yourself. You got to believe that, take advantage of that fire that you have. And conversely, when you're missing, when you're 0 for 15, when you haven't hit a single three all night, then you step up to the free throw line and you can't hit your free throws. Probabilistically, if you know that you're a 50% shooter, or even a 40% shooter, or even a 30% shooter, if you've gone 0 for 15 for the night, you know your probabilities of hitting the 16th shot are way higher than 40, 50%. They're like on the 70, 80 level. I think the shooting metaphor fits very well. If you've gone 0 for 15, don't let that crumble your confidence. Every missed shot is one step closer to you making a shot. And so how does this apply to trading? Why are we talking so much about basketball? Well, recently I went through a bit of a losing streak. And every single trade that I had, no matter how good the idea was, sometimes the market's just going to punish you and things are not going to work out. We deal with risk, we deal with probability, and even when you think you have the absolute best idea, sometimes it's not going to work. And that's okay. That's the beauty of this game. It's constantly solving a puzzle. I've said to so many people, I think my favorite thing about trading is every day you have a brand new puzzle to solve. There are new inputs, there are new information, there's new data. And so the puzzle every single day is not the same, and you got to figure out how to solve that puzzle so you can bring home the P&L, baby. And so when things are not working, you can be down in the dumps on yourself, you can cut back your size, you can play a little sheepishly, you can get all rigid and tight and make sure you're following your system to a T and you're not, doing anything outside, which is something I used to do, by the way. When I first started trading, it's something I used to do all the time. And when I would have a string of losers, I was like, okay, well, I've got to follow these exact rules, and I would really freeze up and I'd be nervous to like put on risk and I would let opportunities slip out of my hands. But now that I get it, now that I've sort of read this in the book and it's almost confirmed this idea for me, when you're on a string of losers, as long as you're clipping your losers at the right spot, you're not letting things get out of hand, you're one step closer to the winner. You have 3 losers today, your chances of a winner tomorrow are high. And if you lose again tomorrow, your chances of a big winner on the following day are really high. So you got to make sure you're on it every single day. Every single day you have to have that mindset. Today's my day. It doesn't matter what happened yesterday. I traded those losers perfectly yesterday. Today, I'm that much closer to a win probabilistically. And so I've got to make sure I trade this stock exactly how I traded those stocks. I'm not going to cut back my size. I'm not going to be sheepish. I'm not going to be shy. I'm going to go for it the same way that I go for it on every single darn trade. And the same thing goes when you're hot. You start to make a little bit of money on a couple stocks, a couple of your ideas that maybe were mediocre are working, a couple of your ideas that were really good are working really well. You might be in your hot streak. Consider getting a little bit bigger in your size. Consider getting a little more aggressive. Maybe not widening your stop just a little bit. I'm not saying to do anything crazy. Don't go from $1,000 losers to $10,000 losers because that's completely not part of your model. Don't go from pressing stocks only up 1 to 2% to pressing stocks up 10%, which is effectively your exit point. Don't go from, if you typically trade 2 beta names, you buy, let's say 2,000 shares, don't start buying 5,000 shares. But if you're buying 2,000, go to 2,500, maybe press it to 3. If you're really hot right now, take advantage of the heat that you have. I've been on some really bad losing streaks, but let me tell you something, when you get through those, you will hit some crazy win streaks and you want to capitalize on that. And so have that shooter's mindset that when you're on the wins, when things are going your way, don't stop, go for it. Get a little bit aggressive, get excited, come in the morning like this is my morning. I'm going to crush it today. That's the mindset you have to have every single day you walk in the office. But I'm just telling you, don't get down on yourself in the losers. Trade them right. They're a part of the game. It's a part of the business. And every single loser that you have in a string is going to get you one step closer to a win. And when you're having consistent wins and you're making money every day, push yourself. Believe in yourself. Absolutely go for it and try and smash your P&L for that month. So that's my trading tip. And the reason why I bring that up is because it's something I'm going through right now. I sort of came out of this losing period for sure. And, I've had a couple days now where I've seen some success and things are going my way. And I feel like I'm trading well and I'm doing things the right way. And my ideas are starting to hit. And so I'm starting to get that sense of like the red light was on. for a couple weeks, green light just turned on. I've got to go fast through the intersection. And I think it also brings a little bit of humanity to me. I think I sit on this podcast and people listen to it and they think, gosh, like this guy has it all figured out. Let me remind you, I'm 26 years old. I by no means have it all figured out. I'm learning every single day. There's things that I still make mistakes on, but that's the beauty of this game. I think anyone in this game will tell you that they still make mistakes. Nothing's perfect. Even your best ideas are not going to work sometimes. And that's the beauty of this process and the beauty of this business and why I love it and why I come in and do it every day. It's truly, truly, truly a beautiful thing. And it's that ideal that I'm chasing every day. And even if we never achieve that ideal, getting close will unlock some great trades and great gains and a really awesome career. And so with all that, I conclude the episode. Thank you so much for listening. Like I said, my name is Alex Ivanovich, and I'm a trader at Spoonbill Partners, LLC, trader and investor at Spoonbill Partners, LLC. Please be sure to check out my short form content on Instagram, TikTok, and on YouTube. I post almost daily on there. I just take a break sometimes on the weekends. I hope you've enjoyed the episode, and I hope you have a fantastic Friday and an even better weekend. Take care, and I will catch you on the next one. The content of this podcast is provided for informational and educational purposes only and should not be construed as financial, investment, legal, or tax advice. The views and opinions expressed by the host and any guests are solely their own and do not reflect the views of any employer, firm, or affiliated institution. Any examples or strategies discussed are general in nature and may not be appropriate for your personal circumstances. Always consult a licensed financial advisor or other qualified professional before making any financial decisions. The host and production team assume no liability for any loss or damage resulting from reliance on the information provided in this podcast.